Hello and welcome. My name is Jonas Thulin. I'm head of asset management here at Erik Penser Bank, and I will try to, as briefly as possible, go through our house view and how we position ourselves. And we can skip the first slide because that's in Swedish and jump in straight into the debt ceiling. We all know about the debt ceiling. It's here. We're gonna hit through it sometimes in June, depending on the tax incomes for the government, which is a bit of an unknown due to the response system in California due to natural disasters. You can postpone your tax payments, etc., etc. That's why the date is a bit uncertain. But the debt ceiling is here, we can't deny that. So what we have done is we've gone through the history and we have put out what sectors should you definitely avoid. We have sold off those holdings, if we had any. And we build this on statistics from 2011 and forward. And on the right-hand graph, you can see the average in red and how these sectors have performed. And then you have the debt ceiling and the solution, and then they outperform the S&P 500. So it's an open question if we should try to ride the upside, but before that we need to see a solution. So how stressed is the market about this? Well, we don't look at CDSs because we think they are a bit illiquid and they don't tell us too much. But instead we use calendar spreads. So we look at the spread in treasury bills between May and June. If we update this morning, it's down to 1.4. The market has made a call that around 10% they will become really nervous. Obviously 1.4 is a huge way away from 10%. Therefore, the equity market has broken its correlation and started to rally away from the fixed income market. And we think that's the right conclusion so far given the debt negotiations. Obviously, we update this and keep monitoring this 24/7. So if the things go from better to worse, we know we have plans to how we're going to act in the portfolios. But unless it goes to worse, we will not front run it with a bearish point of view. We think that's way too risky, and I will come back to that a bit more. This is not to say that we are fully in line with the media consensus. As I calculated here, the uncertainty in terms of markets from the media consensus compared to what's priced in the market is actually about 3 times. It all changed in 2016. As you can see, historically, the market used to be more nervous than the media, and then we crashed and the media caught up. That was the IT experience, the Lehman experience. This time around, we have a landscape out there that is uber bearish, I would argue, and we're happy to trade against that. In terms of the macro context or the market context, this is the graph that we've been using now for quite some time. We still believe that we're moving away from a low growth, high inflation to a low growth, normal inflation. That alone is a delta of 25 percentage points on the equity market. This is something we should not sort of forget, that this is actually happening systematically within the market. We're moving away from this left-hand pillar in the circle with the gray yellow arrow to the right hand. So we would argue this is horrible to miss, because that means you will miss the best upside days. And we all know what happens to a portfolio if you miss 10 of the best days on the upside. Given the 20-year history here that JP Morgan has published on Bloomberg, you will miss a tremendous amount. You will mix 1.5 times your money rather than a lot more if you're fully invested the whole time. This has actually been accentuated a lot during the last couple of years. Now we'll come back to that. But to underweight equities or even go neutral the last couple of years, we think is a huge mistake. Currently, and I'll come back to that, currently, if you look at, you should be 60-40, 40-60, you should definitely be in the 60-40 camp. There's no statistical reasoning why you should underweight equities for the time being. You are clearly underperformed the index. And we calculate this by the blue time series. Unless it breaks down, we won't move. The beige is a market risk indicator. No, we're not concerned about our overweight in equities for the time being. And one of the reasons for that is this kind of statistical analysis is a hat tip here to macro bond, which look at if you had like $100 whatever dollars on the 1st of 1st 2020, and you knew you're going to have pandemics again, and you're going to have war, inflation, etc., etc. It's quite interesting to take a step back and say, well, if I had $100, what would have made the best investment? 100% fixed income, 100% equities. This is global benchmarks. And you can see that in terms of max or drawdown, they're actually equal. In terms of returns on investments, you should be 100% equities. And as the right-hand graph shows, you have up to today about twice the vol in fixed income rather than you have in equities. Even though you have the blowout in the beginning and in the pandemics. So on a risk-adjusted basis, measured today, which is always a bit, is that the right measurement or whatever, you're actually both in absolute terms, but also in a risk-adjusted terms, better off with a high degree of equities. And this is why we think, and I sometimes call this verbally, it might be nice to go out there and say, oh, it's a bit uncertain, we go with risk neutral or we underweight risk, and that's great, but you're losing out of money, you're losing clients' money. And I think that's what matters at the end of the day. This is why we have been working tactically a lot more in our portfolios rather than shifting too much on the strategic weight. And this is quite interesting. There's a little bit of a new school of thought here in terms of how important tactical asset allocation is compared to strategic, as the strategic seems to be pretty much fixed in you should have as much equity as possible. What equities is another question, how you work with that. And there's a great podcast here from Goldman Sachs that I can highly recommend. So that's one of the caveats we want to kill off. No, this hasn't been the time to overweight fixed income, and we would love to see the stats of those who argue it will be. And is it time to sell in May and walk away? Same answer, no. Unless you hold the strategy for 11 years and you time a European debt sovereign crisis during the summer, yes, you can do the math to work, which I've shown in the left-hand graph. If you just run this continuously, no. If the equity market is up during the spring, you have a 10% chance of actually making money on selling May and walk away. Otherwise, it might be softer returns, but still positive returns. So we do not sell in May and walk away. We stick to our guns here in terms of equities. In terms of inflation, speaking of sticking to our guns, we called out the peak inflation in June last year. That's when we took off our last cash positions and hedges and put in to work in the equity market. We claim that the CPI will hit the 3 handle in the summer, and we still stick to that. We're almost up now. It's almost been a year since we made these predictions, but the variables we look at on the left-hand side are still working for lower inflation. So we're more and more concerned about deflation now than inflation. If you look at it on the right-hand graph, we can sort of almost pinpoint that, yes, we're going to have low 4 digits or even high 3 digits with the next monthly read on the CPI, which will be hugely interesting. On the left-hand side, you can see what kind of month-on-month increases in CPI and what kind of trajectory that will be for the headline. And clearly you can see the risk of not only disinflation, but actually deflation is increasing. So, as I mentioned, we increased risk at the top of the inflationary pressure, given the idea that it will roll over, and if you're going to have a rebound anywhere, it will not be in fixed income, it will be in equities. So, compared to peers and indices, yes, it's been right, but obviously we're still down if you combine it with 2022, so we're still working obviously quite hard and focused to repair the 2022 damage. But clearly, even the Fed's own measurements on inflation are turning lower. I know that a lot of people are claiming they're looking at PCE, blah, blah, blah. Well, or we can just look at what their own publishing and in terms of their own preferred common inflation measurements are. Now, the owner's equivalent rent, as you're well aware of, it's the when you ask homeowners how much would it cost to rent your house given the house prices, insurance, and rates. It's clearly turning lower, and that's the last big building block. That's about 45% of CPI. In terms of contributing to the monthly number, it has been up to 70-80% for the last couple of readings. So this is a huge swing factor, and it's swinging down now, and that's going to be interesting. And this is why we're holding our long US Treasury positions and curve steepness, etc., etc. On the back of this, the supply bottlenecks are obviously clearly gone. We've been arguing this from end of 2021. Become almost a bit boring now to show this slide every second week, but I think what strikes me now with these indicators is that they don't bounce. I.e., we don't see a stabilization or a rebound in the supply chains, and clearly we have huge players out there exporting deflation. And I will show you a bit more in a couple of seconds. But this is quite, it almost becomes a bit more stressful on the downside, if anything. Sticky? No. It's never really been sticky. It's not going to be sticky this time either. All the measurements that people claim are sticky, yes, they can hang on for a couple of months, but they always roll over, given the headline. Wages aren't driving inflation. Inflation is driving wages, so it clearly rolls over as well with the CPI. As I mentioned before, China is a good example of a country, and I show you here the spread between PPI and CPI as a measurement for front-running US CPI. If you look at the import prices in US from China, you can clearly see a strong, very strong deflationary pressure. So clearly the global cycle is again producing disinflation and even deflation, which I think is quite interesting. In terms of wages, this is a horrible graph, but on the bottom right-hand graph, we put up a lot of data trying to capture the wage pressure in the US, and it's rolling over as per normal, given that CPI is rolled over. As CPI is leading wages, wages do not lead CPI. There we fully buy into Fed's latest research, which we think is spot on actually. Yes, we do know that we are in disagreement with Larry Summers, but we're happy to discuss stats any day. The downside pressure on CPI is quite notable from the cycle with wages and price plans, etc. In terms of Europe, yes, we can also see inflation. We can also see in Spain, etc., and in Sweden the same thing. And here I just put up the statistical relationship between unemployment rate and CPI, just to home in that there is no such thing as we need to see unemployment rise, blah blah blah, in order to CPI to fall by blah blah blah. You can put time limits on your calculations, but we think this is strength and just being open to the data set. And I say, well, nah, we can isolate a decade here and there and try to see a different relationship. But it's very hard to make a relationship given today's macro looking forward, because then I think it's even more wrong. Given the right-hand graph, which I show you, the correlation sign between wage growth and unemployment is wrong. It has to first of all flip before we can even start to argue there is a relationship between the two. This all means that the Fed will start well, they stopped hiking and they're going to start cutting rates in 2023, which is our forecast. On the left-hand side, I show you the forecast by the market from February-March 2022, i.e. before we even start hiking rates, and already then the market was convinced this will end with a cut in rates. Why? Because inflation will fall back very quickly. That has been the base case from the fixed income market for over a year now. And I still sense there's a little bit of a discussion that, oh, they're going to cut rates now because of recession risk. No, they're going to cut rates because inflation is falling over. We always knew that inflation would fall over. So it's yes, the level has shifted, but in terms of trajectory, nothing has really changed from the fixed income market, which I'm pretty sure that people will start to use the word transitory yet again. We'll see. Well, that will be an interesting celebration of that good old word when that pops up again. In terms of next meeting in June, yes, 90% chance. So it's been pending a bit. They're going to be flat, and they're going to start cutting rates going out. And why are we so certain they're going to cut rates? Well, if we compare this cycle with other cycles in terms of Fed, there you can see how they increase the rate, and you can see inflation increasing, and they hike in order to kill off inflation. This time around, inflation is already rolling over quite aggressively, and they keep on hiking. We think there's going to be a cause for a shift in policy, which is quite strong. And how are you going to trade that? Well, one example is to put your money in artificial intelligence, which we did and increased right off the banking crisis. It's a bit complex here, but on the upper right-hand graph, we just put the AI strategy we're using versus CPI trajectories, and you have consumer inflation on the bottom right-hand graph, and then you have the amount of cuts priced in the market. Please note that within the next 2 years, we're looking at 200 basis points of cuts from the Fed already. And that's traded in the equity market. That's what's driving artificial intelligence and other tech sectors on top of the business cases themselves. So it's a huge macro swing factor which we try to exploit. In terms of dovishness, don't forget, peak hawkishness from Fed language was in June 2022. The pivot in terms of the market pricing in a lot of accelerating hikes was in October 22, so it's a bit of old news. But the market's trading along nicely. So on the right-hand side, you can see that the peak hawkishness is leaving the language and yields are rolling over and inverted in order to capture the bounce in equities. You have the language leading by quite some time. So this is really no news that the Fed is shifting the language successively, and they have done that for almost a year now. This all means that the Fed will stop hiking, and then we're going to start cutting, and the ECB will hike a bit more and then start cutting. That's more of an FX play that we try to exploit. And this idea that the Fed should then stay higher for longer, that's a great idea. But in order, statistically, we know that, which I show you here with mean and median on the left-hand side, the Fed has never really been able to do that. And we've had strong inflation cycles before, but do also remember this is the first time they're hiking rates whilst inflation is rolling over so aggressively. So you can even argue that it already been uber hawkish, actually, in how they're behaving. So the idea that they're going to need to stay higher for longer, I don't really buy into that, because we rather just go with statistics and say, well, yeah, they're going to stick you to the guns for about 2 months, and then they're going to start to cut rates again. We do not buy into the argument that's because bank credit cycle is too low or the business cycle, blah, blah. This is more CPI trajectory or anything else. On the right-hand graph is showing S&P 500 develops, and yes, it moves well from the Fed stops hiking. And the underlying inflation in the US is clearly rolled over, so showing left-hand graph, that puts a lid on the 10-year. It's going to roll over. Obviously, there's more money to be made in the short term. Now we're a bit stuck due to the debt ceiling, but we still have a curve steepening in our books. On the right-hand graph, we can show you the absolute level on the 10-year, which is going to roll over from 4.2%, which is where we bought US Treasuries. And we're a bit stuck now here as well on debt ceiling. This idea that we're going to roll over in terms of policies, don't forget that the momentum of hawkishness on a global basis peaked in August 2022. So the market, especially the equity market, has a good reason for creating a trough. We created in June. I think the equity market, as on an index level, created its trough in September. Clear that makes perfect sense, given that's when we had peak hawkishness and everything. And it's a bit interesting that we're still so bearish in a sense, especially since you can't really make, or you haven't been able to make more money on fixed income on an index level. Now that goes into the banking turmoil, and as you can see here, we still follow deposits and flows to money market funds. But importantly, the program, as I show in the right-hand side, were quite rapid and quite big. On this one, on the right-hand side, I tried to illustrate how slow-moving we were in 2008. We were a bit better in pandemic, and this time around we had the solutions over a weekend, hit the market on the Monday, and we start buying artificial intelligence on the Tuesday and Thursday. So you could be quite opportunistic here, and you can see on the left-hand side how financial conditions, yes, they moved up, and then they were sort of killed off quite rapidly. So we're nowhere near the level on financial conditions in terms of stress as we have been due to the rate hikes. So that's quite interesting to remember. So the financial conditions, if you look at how Fed calculates it, you can see that yes, we took it a bit beating in March, but we're moving better. But then you can argue the Fed is not doing a proper job in how they define financial conditions. You can switch over to the Treasury Department and look at their financial stress indicator. And here it's actually quite daunting to try to find the banking term in terms of stress on the left-hand graph. It's so small you can hardly see it. So I blew it up on the right-hand graph just to show you, yes, we had a move that lasted for a few days. We acted on it after 1 day, the big spike. And luckily we have been proven right in terms of the financial stress being lower and coming off quite rapidly. But that leaves the question of what's the effect on the banking cycle. And here I'm going to try to make a long story very short. We have to separate what we already knew was going to happen on the banking lending cycle from what extra additional tightening the banking turmoil has created. Given the fact that financial stress hasn't really been subject to any kind of distortion of the banking turmoil, given the tremendous amount of liquidity being pushed out in the system, you could make the argument that there really shouldn't be any effects on the banking lending cycle whatsoever. So we tried to measure this, and if you look at how NAC is measuring this, you can see, you can't really see any negative movement. You can see a little bit of a negative momentum in the senior loan officer survey, but that's the banks, and we know that that's not always what's actually going to happen when you sit there and actually take the loan. Financial stress indicators on the right-hand side aren't really moving, as you can already see. So that if we move through these type of charts, you can see that yes, you should have a rise in bankruptcies, but that comes on the back of the hikes that we made in 2022. And yes, we have lows in terms of credit availability, etc., etc. It hasn't been worsened by the banking turmoil so far, but they're certainly not good. But we already knew that. That's already priced. And then you can sort of skip the stones here and say, well, in terms of bank lending cycle, what's actually been priced in the market then? And I try to illustrate here in the grain, which I shoot out the forecast in a bit light green, that this is what the market has priced in terms of bank lending. So yes, it should grow negatively. We should have alarming headlines. The banking lending is falling down, is moving negatively. The Fed has to cut rates, blah, blah, blah. But please do remember that's already been priced in by the fixed income market. That's already been priced in by the equity market. We need to develop this one more step in terms of negativism before it actually hits any new turf. I think that's hugely important to remember. If the development becomes worse, we will act. But unless they do, we will just lean back and say we already know this. The market will be able to handle this and then take it from there. So the business cycle then, soft landing, yes, we still have a recession risk. Actually, I updated this graph this morning. It reads 0% recession risk for the US. We think that's a bit ballsy call to make, so we're going to hold off that for a little while to see if the data is revised, what can happen. But clearly, the business cycle is improving following the rebound we see in the global business cycle. So we still stick to a soft landing. We don't buy into a recession. Here we can see a soft landing that should occur in industrial production and the heightened recession risk in the blue brackets, red brackets. But that's also when we have the rate cuts. This has already been handled in the market, etc., etc. And what is an element of surprise is this graph, which I show you in various indicators. You can actually see a rebound in global business cycles, which is hugely interesting, because if they're right, the market has to revise not only their earnings revisions or the earnings on US corporates, but also on the macro side, and that's what's actually starting to occur. So if you start in the right-hand graph here, you can see the top line, the dark line, that's the US GDP forecast for this year. That has troughed and turned around, and it's troughed and turned around for Europe. Sweden lagging, but it will trough and turn around. If you look at the quarterly growth momentum in the US, we're at 2.5%. There's not even a soft landing in the numbers so far. So we might be too bearish on US outlook. And that's a huge shift for the equity market, obviously. Which is what I think also our participants are more stressed on missing the upsides than avoiding downsides. And if you look at our year-on-year growth in the US is stable. In Sweden, you can actually see a little bit uptick. So it's not 100% certain that Sweden will even enter a recession. Now, in terms of data, coming from the next couple of weeks before we look at the equity market, we do not trade on PMI, but we think they're good fun to study, and we can certainly see the second derivative and the trough. You can see just on the colorization there that we've gone through a very negative period. There are those banks out there, big US investment banks, that claim that the very most negative momentum we had was the end of Q4 last year. Since then, we're rebounding. We certainly buy into that, even though we outweighed Europe by them. But it's hard to trade on PMI in that sense. But the trough is certainly there. And here you can just see some short-term indicators that we're using for pinpointing ISM and PMI. So obviously we think there's more momentum on the upside from ISM. And we put in a forecast there in the market for one tick, one figure up in ISM. Non-farm payrolls, 275,000. You can see the indicators are turning. Job postings are a bit concerned. But we think the major move on the downside in terms of indicators seems to be behind us. And that's pretty interesting. Here we look at claims and warrants data. And we do note that warrants data has come off its recent high and it's actually falling back. So we might now actually see the big momentum in claims, which is interesting because that's obviously a big engine behind recession models. ISM, as I mentioned, yes, we see a trough and a little bit rebound, but that's nothing new really. We can already see this is a bit complex graph, but trying to illustrate here is that ISM is lagging a lot of the regional service they already have out there. And do remember that the equity market is sort of traded as if the ISM would start to rebound. This goes back to the whole similarities between this cycle and 94-96 cycle. So we don't think we're going to make money on that, but it's going to be good fun. It's good fun to compete on the ISM forecast. I think we were second on Bloomberg the last time around, so we'll see how we're going to fare this time. But we shift between second and 25th, so it's not always great, but never really bad either. So that's always something. PCE rolling over, might be stuck this month around, but it's going to start to roll over again. IFO, which is actually starting to head into boom sector again. We are heavily invested in German equities, and i.e. also Swedish equities, following the German equities and German business cycle. And this whole business clock that sort of avoided the downsizing and recession turns up to a boom. We think that's hugely interesting. on the right-hand side, you have weekly updated GDP models that's quite supportive. Sweden, horrible from a retail point of view. Obviously, our real earnings peaked in 2014. Since then, the Swedes have to live with lower and lower real wage growth, which is almost a decade-old phenomenon now. If you start to hike rates, etc., you have a collapse in the retail sales. There's nothing really. Well, it's not really hard to predict that one. Given the right-hand graph, you can see that the debt service level in Sweden is very high. It's a record high, and it's very low in the US, i.e. you can't compare rate hikes in Sweden with rate hikes in the US, because they will hit the Swedish consumer a lot more than the US consumer. That has been why we avoided Swedish equities to large parts in 2022. But now we are heavily invested in, because we don't trade equities on this. Now we're following the German and the global business cycle, which is good fun for the equity side, and very, very sad, obviously, for the Swedish retail side. In terms of housing market, the top right-hand table is quite interesting to see how far down we have fallen, given the adjustment we made in our house pricing. And we start to see some fish hooks on the bottom right-hand in terms of price indicators, so that's always good fun to see if that develops. In terms of equity outlook, we predicted we're going to have less negative days in 2023 than 2022. Pretty low risk call to make, but at least we get the market with us, which is good fun, because we were really blown out on the downside in 2022. And if not the fixed income market has been as bad as it was, it would have made bigger shifts in our portfolios. But as I already demonstrated, that is more of a mirage than anything else, that it was a good year to underweight or neutral. Obviously, we are also playing around with alternatives and commodities in order to be able to stick to equities. Because the bounce was always happen, as we predicted, was always supposed to happen in the equity side, and that's what we're seeing today. Driven on the left-hand side, as you can see, by institutions buying. We're almost nearing positive margin depth, which will be good fun. And if you combine flows and sentiments, you can see that after the trough in October-ish, you can actually see that the market has been quite even and quite stable in terms of both sentiment and flows. If you look at risk indicators for the market, you can see that yes, we saw the big downshift on the banking turmoil, but then a big rebound, and we're actually quite stable and positive levels in terms of risk as expressed by fixed income. And here we actually look at CDSs for the US, etc., and fixed income and FX of all emerging market spreads, etc. So the equity market is quite well supported. Free and greed, positive. Flows from cash to equities amongst US institutions. Yes, it still keeps on flowing from cash to equities, which is great if you're already in equities. And on a PE level, if you adjust the PE for the cyclical, the business cycle, basically, so you have a cyclical adjusted PE number and adjust also for the rate environment, you have a buy signal. And this is quite important, because this is what I mentioned a few times. In the green time series here, we capture if the market is more stressed about capturing the upside, then it's stressed to avoid downside. As you can see on the right-hand graph, this actually predicts and front runs the big swings in asset allocation amongst asset managers. And what we like about this is that we could front run this already back in June about holding an increase in equities. And since then, we've been able to not relax, but be certain of the fact that the market is hunting the upsides more than it's avoiding the downsides. And that's also well worth remembering when we talk about strategic asset allocation. And then if you look at economic regime models, yes, they're supporting equity upside as well. If you look at the PMI cycle, we shifted from a contraction to a rebound, so you can see what sectors should outperform. So we shifted even more into tech in the US. And so then you have to make a stand on value and growth if you look at those two big swing factors. And here, if you look at just the positioning in the US market, and then we look at commodities, fixed income, and in equities, you can see that it's been constantly arguing for growth equities, even though the blue time series has proven us both right and wrong from time to time. Right now, we're in sort of a good stride. But we're going to hang on to growth equities, because we don't want to swing the portfolios too often. And long term, we think the model will be right. So we're sticking to growth. And currently, as we're speaking here in end of May 2023, we're certainly proven right for the time being. So we're sticking to this. As I mentioned before, we have always argued this would be a 94-96 development, i.e. the equity market will shoot up as the business cycle keeps on moving lower, but no one really cares, because it's already been priced in. And you can see if you move your eyes from 94-96, when you see this sort of lying, the infinity sign, You can also see the creation of a new one being made as we're speaking, as the equity market is moving rapidly on the upside, leaving the business cycle a bit. Business cycle according to ISM, I should mention, a bit a bit behind the bus here, basically. And that's why we think the earnings revisions are truly a lot more important than ISM, for example. On the left-hand side, these are the big calls we made for 2023, that earnings revisions troughed and they should rebound, and price targets should rebound, and the global business cycle will be surprised on the upside. Fortunately, knock on wood, we've proven right on all three accounts. So right now we have the earnings revisions you can see on the left-hand side moving up with the global business cycle, and price targets moving up. And that's also creating a well-supported basis in the equity market. So how can we spin this a bit further? Well, if you look at earnings revisions, here I look at Europe versus the US. So when we move in green, you have outperformance in Europe versus US, and the time series, the single line here, is how US equities are outperforming versus European. So when it moves on the upside, Europe is beating the US. And what we can note here is that the US has a tendency to come back with a vengeance. So we don't want to stick around too much with our overweight in Europe, which we have had a lot in our portfolios since October, November last year. So what we decided to do last week is actually take a secure profit. Because we believe that the European outperformance, as you can see in the time series on the way, so the green on green here, I'm sorry for that, so the green time series on the green field, is starting to peak, and that's where we want to secure the profit. If you look at the earnings revisions, the US is actually now catching up to European quite rapidly. And why are we looking so much on earnings revisions? Well, do remember that in terms of leading indicators for the equity market, it's clearly a lot better indicator to look at compared to 12-month forward EPS or EPS forecasts that tend to lag. On the right-hand graph, I used to look at the US earnings revisions versus S&P 500, for example, or I think that's MSCI for the US, but clearly there's still an upside momentum here that the market still has to catch up with the earnings momentum. So I'll leave you with that. So some thoughts here on, just more on earnings revisions between US and Europe. We also have a one-pager in Swedish, though. We can translate that if you need. But there's a quick summary of our house view. And we really want to take a note that statistically, no, you should not sell in May and walk away, especially if the equity market has been up during the spring. And then you have a 9 to 10 probability of making more money sticking to equities. Obviously, the debt ceiling is a bit of an unknown here, but we track that, look at the fixed income market. It's not expressing too much stress as we're speaking. And on top of that, we are living in a context now where we're moving away from a low inflation, sort of high inflation, low growth, to a normal inflation and low growth, which is a delta in the equity market, and equity worth about 25 basis points. So the market is clearly stressed of missing out that on the upside. And on top of all this, we're coming on a period since the 2020s where you've clearly been rewarded by sticking to equities, and you've been not rewarded by being risk neutral or concerned and shifting down equity portfolios. And I think that's a huge message to bring with us when we look at how we work with tactical asset allocation and strategic asset allocation. But thank you with that, and I'll be back in a couple of weeks' time with an update. Thank you so much.